Yo, what's good? My name's Kang, like Kangaroo. I'm a Canadian that's currently living and working in Seattle as a software engineer. And on this channel, we explore tips and tricks that you can take advantage of in order to reach fire faster. Software engineering is one of the most lucrative fields that you can get into with just a bachelor's degree and has a real opportunity for you to build generational wealth. But how exactly do you do that last part? Well, in this video, I'm going to be showing you exactly how I take advantage of this opportunity by showing you what I think is the most optimized way to invest if you're in tech. First, I'm going to assume that you're fit for investing. Now, what does this mean? In the same way that I wouldn't expect you to wake up and run an ultra marathon, I also wouldn't expect you to start investing if you don't have a strong grasp on the personal finance fundamentals. Stuff like having a budget, having an emergency fund, and not basically drowning in consumer debt. All right, to better visualize where your money is going and how it's being invested, I want you to visualize this bucket as your salary. I don't know if you can read this, but it says salary. On top of that, I've also laid out some other buckets like your ESPP, your taxable account, and then your 401k. Now, there's a lot of ways that you can invest your money, or in this context, pour your water. So I can't get into every single situation, but this is what I think the most optimized way for the majority of people in tech is. The first thing I think we should take a look at is your employer benefits, or what I call free money. Now, the big one that comes to my mind right away is the 401k. Here we got our 401k bucket. Now, a lot of the big tech companies like Google, Microsoft, Meta, they all have very good and very generous 401k matching programs. Okay, so let's say in our scenario, we work for Walmart Global Tech, and based off my research on levels, they match 100% of our contributions up to 6% of our base salary. So we take our base salary and then we contribute what looks to be 6%. That looks like 6%, right? And what's nice is that our employer surprise secondary work benefit bucket will also contribute another 6% towards our 401k. Now, maxing your 401k is a great idea because it's usually an instant and a risk-free return on your investment. Let's say in our example, we work at Walmart and we make 100k a year. By investing 6%, we're investing $6,000. And since Walmart matches 100%, we're getting another $6,000 basically instantly with no risk involved at all. All right, after we've hit our employer match for our 401k, the next thing that I think we should be investing in is the HSA. Now, from what I'm seeing on levels, a lot of companies have some sort of HSA matching, so why not take advantage of this free money? Now, how the match actually works will differ from company to company, but what I'm assuming is that they're going to contribute a percentage of their total max at the same time that you're contributing, so that by the time that you finish maxing your HSA, their portion will also max at the same time, if that makes sense. Okay, now let's say that we work at Apple. They contribute $750 towards your HSA plan based off what I'm seeing on levels, and the max that you can contribute to your HSA in 2023 is $3,850. Now, it's important to note that your employer's contributions also count toward your yearly contribution limit, so you would only need to contribute $3,100 in order to meet the HSA limit for the year. Okay, so first we contribute $3,100 into the HSA. I mean, that looks like it was the amount for the 401k, but let's just say that's $3,100. And then Apple will come in and then contribute another $750 into the HSA. Now, if you do the math, this ends up being a 24% return on your money if you work at Apple. The HSA is probably the most tax efficient account that you can have in America. It uses pre-tax dollars. The money grows tax-free, and you don't pay taxes if you use it for registered medical services. And if you end up not using any of this money, you can pull it out at the age of 65 when you're retired. But since you can only get an HSA if you're using the high deductible plan, you will need to have a surprise third bucket as an emergency fund just in case you break your leg or something like that. Oh, that tastes weird. Okay, so now after the HSA, I really think that we should be taking advantage of our ESPP, which is right here, ESPP bucket. ESPP stands for Employer Stock Purchasing Plan. It's a work benefit that basically allows you to buy your company stock at a discount. Now, I have a whole entire video that goes pretty in depth on this topic, so I really recommend checking it out if your company has an ESPP. But in short, let's say that you work at a company like Visa. They let you contribute 10% of your yearly salary in order to get a 15% discount on their stock. So how it works is that you're going to invest 10% of your salary over, the span of the year. And after a holding period, which is usually 3 months, Visa will now give you a discount on their stock. In this case, it's 15%. At this point in time, you can sell the stock right away and diversify into another asset. You can sell the stock and just pull the money out to hold on to it, or you can keep the stock. In any case where you sell right away, you are getting an instant 17.65% return on your investment. Now, this math might seem a little bit wonky, but you're gonna have to trust me. This is how the math works. You can just check my video if you don't believe me. Now, let's pretend that we have a 100K salary. If you invest 10% of your salary, which is $10,000 a year, and you get a 17.65% return on your investment, that means that you're gonna get an additional $1,765 a year. Now, this doesn't seem like a lot of money, might not seem like it moves the needle, but what's important to remember is by investing into your ESPP, you are forced to invest 10% of your salary every single year, which in my opinion is a great way to force you to invest. All right, after we've contributed to our ESPP, that basically rounds up all of our work-related benefits that I can think of. The next account that I think we should be taking a look at is the Roth IRA. The Roth IRA lets you contribute after-tax dollars, which can grow tax-free and can be pulled out tax-free. Now, the limit that you can contribute to the Roth IRA in 2023 is $6,500. Let's do that. Let's contribute our $6,500. If you make more than $153,000 a year, if you're a single filer, you will not be able to contribute to the Roth IRA in the normal way. What you have to do is called the Mega Backdoor Roth. There's a ton of YouTube videos explaining this. I'm not going to get into it. And there's a ton of articles, so I'll just link some down below that you can take a look at if you want to do this. All right, so after we finish investing into our Roth IRA, what makes sense to me is to actually go back to the 401k and continue to max that. So in 2023, the IRS limit for the 401k is $22,500. What's important to note is that our work-sponsored contribution, which was at $6,000 because of the match, that does not count towards that IRS limit. So in order to max our 401k, we need to invest or contribute an additional $16,500. $16,500 is a lot, so I'm going to assume that has $16,500 in there right now. And what's great about the 401k is that it uses pre-tax dollars, which therefore will reduce your taxable income for the year. And since a lot of software engineers are in a higher tax bracket, this will greatly reduce the amount of taxes you will pay over the years. Now, the 401k is no free cake. You're still going to have to pay taxes, but instead of paying them right now, you're going to pay them when you eventually pull it out. And the idea is while you're making all this high salary, you're investing into your 401k, you're letting it grow tax-free. And then when you're old and wrinkly and your income's a lot lower, that's when you're going to pull out of your 401k and you're going to pay taxes at that time. Now, at some point, you may also get an RSU, which is a stock portion of your compensation package. And from my understanding, the majority of the time, the company will actually withhold some of your stocks in order to pay for your tax. Now, if you have any questions about if your taxes are being withheld on your RSU, make sure to reach out to your HR department or your benefits department. They definitely know the answer to that question. Now, once those RSUs hit your brokerage account, you have a couple different options. You can sell the RSU right away and diversify into another asset. You can sell the RSU and then pull the money out, or you just keep it and let it chill. What I personally do is I keep my RSUs. Maybe I drink a little bit too much of the company Kool-Aid, but I already do a lot of investing outside the RSU. So for me, it's a relatively small portion of my portfolio and it's a risk that I'm okay with. All right, so now that we've taken advantage of all the work benefits that we have and all those tax sheltered accounts that we have, now we're going to finally move on to the last thing that we can invest in, which is the taxable account. Like I said, tax account, that's the last one we want to be investing in. Now, the taxable account can look different for different people. Some people, maybe this is Bitcoin or crypto. Other people, maybe this is just a regular brokerage account like M1 Finance or Fidelity. Or some people, maybe this is a savings account for a potential rental property that they want to buy. At this point in time, I think you could also take a look at paying down some of your student loan if you have a bigger loan balance or if your interest rate is particularly high. I personally went to school in Canada and the majority of my interest rate right now is actually at 0%. So I am in no rush to pay that off. But let's say for the sake of simplicity, we're going to take the remainder of our salary and invest all of it into a taxable account. Let's just say that it's M1 Finance or Fidelity, just to keep it simple. Now, all this might make sense when I deal with these silly buckets, but how do you actually do this practically? I mean, I get it. It's confusing. First, you start with your 401k, you do it until you hit the match, then you go to the HSA, then you go to the ESPP, then Roth IRA, then back to the 401k. It's just a lot of sauce, like I understand. Now, for some people who are nerds like me, this level of optimization is definitely worth it. But for other people's and the majority of people, I don't think that it is. What will probably work better for the majority of people is just to sit down at the beginning of the year, plan out how much you want to invest into each of these little buckets, and then spread that out evenly throughout the year. Now, is this the most optimized way to get all of the free money that you can as fast as possible? No. But is it a lot easier? Yes. All that really matters is that you pick an investing strategy that you can really understand and that you can stick to. And as far as what you want to invest into, that's completely up to you. I don't know your situation, but I can say this. The majority of people who invest into individual stocks, who do day trading, options, Forex, crypto trading, all of that, end up with less returns than if they had just invested into regular, boring index funds. Now, you might think that you got it in your bag, that you're sick. Trust me, you don't. You're not that guy. And if you're wondering, this is what I personally do. First, I max my 401k because my company has a very, very good matching program where I get basically like $10,000 or $11,000, whatever it is in the year. After I do my 401k, I then max my ESPP every single month. I contribute to it, contribute the max, which is for me is 15%. I do not invest into my HSA, and then the rest of the money I invest into a taxable account. As for what I invest into, aside from my RSUs, which I get from my company, I invest solely 100% into VTI. I also invest into Bitcoin, which I did not put, but this would be part of the taxable account as well. And depending on your situation, your cost of living, your job, you may not be able to do all of these different buckets that I have laid out. What I recommend doing is taking advantage of as much free money as you can and taking advantage of all the tax sheltered accounts that you can. And for a lot of people in tech, this is definitely doable. If you have any specific questions or video ideas, please feel free to leave them down in the comments. I have no life, so I will answer your questions. And if you have any video ideas, I most likely will do it too. And if you're actually curious about how I was able to move from Canada to the US for work, you can watch this video right here where I go over my salary progression from $11 an hour to $80 an hour. That was the wrong one. Okay, gonna do that part again.